Picture this scenario. You're scrolling through your investment app at 2 a.m., second-guessing every decision you've made with your retirement savings, wondering if you're doing this whole wealth-building thing completely wrong. Meanwhile, there's this mysterious group of people, the top 1%, who seem to have figured out some secret code that the rest of us are missing. And here's what's really fascinating about this group. Once they hit 55, their investment strategy completely transforms. It's like they're playing by an entirely different set of rules that nobody else seems to know about. My name is Keith, and I spend way too much time researching what wealthy people actually do with their money, not what they tell us they do, but what they actually do. And if you've ever wondered how the ultra-wealthy think about money after age 55, and more importantly, what specific investments they're pouring their cash into during this critical phase of their lives, make sure to hit that subscribe button, because what I'm about to share with you will probably challenge everything you think you know about retirement investing. Now, before we dive into the secret playbook of the ultra-wealthy, let me ask you something that might make you uncomfortable. When you think about retirement planning, what's the first thing that comes to mind? If you're like most people, you probably picture yourself slowly withdrawing money from a 401k, or maybe living off Social Security benefits while trying not to outlive your savings. That's the traditional retirement model that's been drilled into our heads for decades. Work for 40 years, save 10% of your income, retire at 65, and hope your nest egg lasts until you die. But here's the thing that might blow your mind. The top 1% don't think about retirement the same way at all. See, when you have serious money, retirement isn't about surviving off your savings. It's about structuring your wealth in a way that generates enough income to maintain or even increase your lifestyle without ever touching the principal. And this shift in thinking leads to completely different investment choices that most financial advisors never even mention to their middle-class clients. The wealthy don't just save for retirement. They build wealth machines that keep printing money long after they stop working. But here's where it gets really interesting, and this is something that took me years to understand. The investment strategies that work brilliantly when you're young and accumulating wealth can actually become counterproductive after age 55. Think about it this way. When you're 25 and investing in growth stocks, you can afford to ride out market crashes because you have 40 years until retirement. A 30% drop in your portfolio is scary, but you'll recover. When you're 55 with a significant portfolio, that same 30% drop might represent more money than you earned in the first 20 years of your career. Suddenly, volatility isn't just inconvenient, it's potentially catastrophic. This is why the ultra-wealthy completely restructure their portfolios around age 55, and what they move into might surprise you. The first thing you need to understand is that wealthy people after 55 aren't really investing for growth anymore. They're investing for income, tax advantages, and wealth preservation. Growth becomes secondary to cash flow and protection. It's like they switch from playing offense to playing defense, but they're playing defense at such a high level that they're still generating returns most people would consider aggressive. Let's start with something that'll probably make you rethink everything you know about real estate investing. The ultra-wealthy absolutely love commercial real estate, but not in the way you might think. I'm not talking about buying apartment buildings or strip malls and becoming a landlord. That's small-time stuff compared to what they're actually doing. They're investing in what are called triple net lease properties, also known as NNN properties. Here's how this works, and the numbers are going to make your head spin. Imagine you own a Walgreens or a McDonald's building. The tenant signs a 20-year lease where they pay not just rent, but also all property taxes, insurance, and maintenance costs. You literally collect a check every month while they handle everything else. The wealthy love these deals because the returns are predictable, the tenants are credit-worthy corporations, and the income is essentially guaranteed for decades. A typical NNN property might generate 6 to 8% annual returns with minimal management required. It's like buying a bond, except the interest payments tend to increase over time rather than stay fixed. But here's where it gets really sophisticated. The ultra-wealthy often purchase these properties through what's called a Delaware Statutory Trust, or DST. This allows them to own a fraction of a massive commercial property alongside other high-net-worth investors. Think about it like owning shares of stock, except instead of owning shares of a company, you own shares of a $50 million office building leased to Amazon for the next 15 years. The minimum investment is typically around $100,000, which keeps most people out of these deals entirely. But for someone with serious wealth, it's a way to generate steady income while enjoying significant tax advantages. Speaking of tax advantages, let's talk about something that might make you question everything your financial advisor has told you about municipal bonds. The wealthy absolutely love municipal bonds, but they're not buying them the way you might think. While regular investors might buy individual muni bonds for their tax-free income, the ultra-wealthy are purchasing closed-end municipal bond funds that trade at discounts to their net asset value. This is where things get mathematically beautiful. Here's how this works. A closed-end fund might own $100 million worth of municipal bonds, but the fund itself might be trading for only $85 million on the stock exchange. The wealthy can buy this fund at a 15% discount, immediately gaining 15% in asset value while collecting tax-free income that might yield 5 to 7% annually. It's like getting a 15% instant return plus ongoing tax-free income. The catch is you need to understand how these funds work and have enough money to make the investment worthwhile, which is why most people never hear about these opportunities. Now, let's dive into something that'll probably surprise you about how the wealthy think about dividend-paying stocks after age 55. You might assume they just buy high-dividend ETFs and call it a day, but that's not how they operate at all. They're focused on what are called dividend aristocrats and dividend kings. These are companies that have increased their dividends every single year for at least 25 years. We're talking about companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble, companies that have been paying and increasing dividends through recessions, wars, and market crashes. But here's the sophisticated part that most people miss. The wealthy don't just buy these stocks for the current dividend yield. They buy them for the dividend growth rate. A stock that yields 3% today but increases its dividend by 8% annually will be yielding much higher amounts on your original investment within a decade. It's like buying a bond where the interest payments keep going up every year. Johnson & Johnson, for example, has increased its dividend for 59 consecutive years. If you bought J&J stock in 1990, your dividend yield on that original investment would be approaching 20% annually today because the dividends have grown so much over time. The ultra-wealthy also love something called covered call strategies on their dividend stock positions. This is where things get really interesting from an income generation perspective. Here's how it works. Let's say you own 1,000 shares of a dividend-paying stock like Microsoft. You can sell call options against those shares, collecting immediate premium income while still owning the stock and receiving dividends. If the stock doesn't reach the strike price, you keep the premium and the shares. If it does reach the strike price, your shares get called away at a profit, and you find another stock to repeat the strategy. Done properly, covered calls can add an extra 8 to 12% annually to your returns on top of dividends. The wealthy love this strategy because it generates immediate income while providing some downside protection. The premium you collect from selling the calls reduces your cost basis in the stock, creating a buffer against market declines. It's like getting paid to potentially sell your stock at a higher price. But let's talk about something that might completely change how you think about alternative investments. The ultra-wealthy after 55 are absolutely obsessed with what are called business development companies, or BDCs. These are essentially publicly traded private equity funds that loan money to middle-market companies. Think of them as banks for businesses that are too big for traditional bank loans but too small for Wall Street financing. BDCs typically yield between 8 and 12% annually, which sounds amazing, but here's the catch that most people don't understand. These yields are largely supported by the fees and interest income from their loan portfolios, but they can be volatile because they're essentially credit investments. When the economy is good, BDCs print money. When credit conditions tighten, they can struggle. The wealthy invest in BDCs during the right part of the economic cycle and exit before things get ugly. It requires sophisticated timing and deep understanding of credit markets, which is why these investments work better for people who can afford to lose money if they get the timing wrong. Now here's where things get really fascinating, and this might make you rethink everything you know about international investing. The ultra-wealthy love foreign government bonds, but not for the reasons you might think. They're not trying to diversify their currency exposure or capture higher yields in emerging markets. They're using foreign bonds as a hedge against domestic monetary policy and inflation. Here's how this works. When the Federal Reserve prints money and keeps interest rates artificially low, it devalues the dollar and creates inflation risk. By owning bonds denominated in currencies like Swiss francs or Norwegian kroner, the wealthy are essentially betting that these currencies will maintain or increase their value relative to the dollar. If they're right, they get paid twice, once from the bond yield and once from the currency appreciation. It's like having an insurance policy against your own government's monetary policies. But perhaps the most sophisticated strategy the ultra-wealthy employ after 55 is something called tax loss harvesting in municipal bond ladders. This is so complex that most financial advisors don't even understand how it works, let alone implement it properly. Here's the basic idea. You build a ladder of municipal bonds with different maturity dates, say one maturing every year for the next 20 years. As interest rates change, some of your bonds will trade below their purchase price, creating tax loss harvesting opportunities. You can sell these bonds, realize the tax loss to offset other gains, and immediately purchase similar bonds to maintain your income stream. Done properly, this strategy can add 1 to 2% annually to your after-tax returns while providing steady tax-free income. The wealthy also love master limited partnerships, or MLPs, but they approach them very differently than typical investors. MLPs are partnerships that own energy infrastructure like pipelines, storage facilities, and refineries. They're required to distribute most of their cash flow to investors, often yielding 6 to 10% annually. But here's the sophisticated part that most people miss. MLP distributions are largely considered return of capital rather than taxable income, which means you don't pay taxes on most of the distribution when you receive it. Instead, it reduces your cost basis in the investment. You don't pay taxes until you sell the MLP, and then it's often taxed at favorable capital gains rates. The ultra-wealthy love MLPs because they provide high current income with significant tax deferral. It's like getting a loan from the government at 0% interest while your investment continues generating returns. The catch is that MLPs are complex investments with unique tax implications, and they tend to be volatile based on energy prices and interest rates. You need serious money and sophisticated tax planning to make MLPs work effectively. Let's talk about something that might blow your mind about how the wealthy think about real estate investment trusts, or REITs. Most people buy REIT ETFs for diversification and steady dividends, but the ultra-wealthy are focused on specific types of REITs that most people never even consider. They love data center REITs, cell tower REITs, and healthcare REITs because these sectors have predictable, growing cash flows supported by long-term trends. Think about data center REITs like Digital Realty Trust. Every company needs more data storage and processing power every year. The demand for data centers is essentially unlimited, and the leases are typically long-term with built-in rent escalations. Cell tower REITs like Crown Castle work similarly. As our society becomes more connected, the demand for wireless infrastructure only grows. These REITs often have 99% occupancy rates with rent increases tied to inflation or usage growth. Healthcare REITs are particularly interesting because they benefit from the aging population. Companies like Welltower own senior housing, medical office buildings, and skilled nursing facilities. As baby boomers age, the demand for healthcare real estate is essentially guaranteed to grow. The wealthy love these sector-specific REIT plays because they're investing in irreversible demographic and technological trends rather than hoping for general market appreciation. But here's something that might completely change your perspective on bond investing. The ultra-wealthy after 55 are absolutely fascinated by Treasury inflation-protected securities, or TIPS, but they're using them in ways that would never occur to most investors. TIPS adjust their principal value based on inflation, so if inflation goes up, the value of your TIPS increases accordingly. The wealthy often ladder TIPS with different maturity dates to create an inflation-adjusted income stream that maintains purchasing power over time. But here's the sophisticated twist. They're often buying TIPS in tax-advantaged accounts and pairing them with I-bonds, which are inflation-adjusted savings bonds that can be purchased directly from the government. I-bonds currently yield over 5% and adjust for inflation automatically. The catch is, you can only buy $10,000 per person per year, which is pocket change for the ultra-wealthy. But when you combine I-bonds with TIPS ladders and inflation-protected municipal bonds, you can create a portfolio that actually benefits from inflation rather than being destroyed by it. Let's dive into something that'll probably make you rethink everything you know about private credit investments. The ultra-wealthy absolutely love direct lending funds, but these are investments that require minimum commitments of $250,000 or more, keeping most people out entirely. Direct lending funds loan money directly to companies, cutting out traditional banks as intermediaries. Because they're taking on credit risk and illiquidity risk, these funds often target returns of 12 to 15% annually. Here's how this works in practice. A company needs $50 million to expand their business, but they can't get traditional bank financing because they're too leveraged or growing too fast. A direct lending fund steps in, provides the loan at 10 to 12% interest, and passes most of that return on to investors after fees. The wealthy love these investments because they generate high current income while being somewhat insulated from stock market volatility. The catch is that you're taking on significant credit risk, and your money is typically locked up for several years. Now, here's something that might surprise you about how the wealthy approach precious metals after age 50. You might think they just buy gold coins or gold ETFs, but they're actually much more sophisticated in their approach. Many wealthy investors own gold through what are called precious metals IRAs, where they can hold physical gold, silver, platinum, and palladium in tax-advantaged retirement accounts. But here's the really interesting part. They're often using precious metals as collateral for loans rather than holding them as traditional investments. Banks will lend against physical precious metals at very attractive rates, often 2 to 3% annually. The wealthy can borrow against their gold holdings to fund other investments while still maintaining ownership of the metals. It's like having your cake and eating it too. If gold prices rise, they benefit from the appreciation. If their leveraged investments perform well, they benefit from those returns too. It's a sophisticated use of leverage that requires significant assets and careful risk management. Let's talk about something that most financial advisors never mention: but the ultra-wealthy absolutely love after age 50. Structured notes. These are complex financial instruments that banks create to provide specific risk and return profiles that can't be achieved through traditional investments. For example, a structured note might provide 100% downside protection on the S&P 500 while capturing 75% of any upside over a 5-year period. Here's how a typical structured note might work. You invest $1 million in a note tied to the S&P 500. If the S&P 500 goes down over the next 5 years, you get your $1 million back. If it goes up 50%, you get back $1.375 million, capturing 75% of the gain. You get market participation with complete downside protection. The catch is that these notes are issued by banks, so you have credit risk if the bank fails, and they're typically illiquid until maturity. The wealthy love structured notes because they can create very specific risk profiles that match their exact needs. Need exposure to emerging markets with limited downside? There's a structured note for that. Want to benefit from volatility in the energy sector while protecting principal? There's a note for that too. It's like having custom investments designed specifically for your risk tolerance and return objectives. But perhaps the most fascinating aspect of how the ultra-wealthy invest after 55 is their use of family-limited partnerships and grantor trusts. These aren't really investments themselves, but rather structures that allow sophisticated estate planning while maintaining investment flexibility. A family-limited partnership allows the wealthy to transfer assets to their children at discounted values for estate tax purposes while maintaining control over the investments. Here's how this works in practice. A wealthy individual transfers $10 million worth of investments into a family-limited partnership, then gifts limited partnership interests to their children. Because the children don't have control over the investments, the gifts can be valued at a 20 to 40% discount for estate tax purposes. The wealthy individual maintains control as the general partner while effectively removing assets from their estate at discounted values. It's like getting a 20 to 40% tax deduction on estate transfers while maintaining investment control. Grantor trusts work similarly, but provide even more sophisticated tax benefits. The wealthy can set up irrevocable trusts that are designed to grow outside their estate while they pay the income taxes on trust earnings. This allows the trust assets to compound tax-free while the tax payments further reduce the wealthy individual's estate. It's like making tax-deductible gifts to your own family while the assets continue growing under your indirect control. Now let's talk about something that might completely change how you think about insurance as an investment vehicle. The ultra-wealthy absolutely love permanent life insurance, but they're not buying it for the death benefit. They're using it as a sophisticated tax shelter and investment vehicle. Policies like whole life and universal life allow unlimited contributions above the required premiums, and the cash value grows tax-free as long as it stays inside the policy. Here's where it gets really interesting. The wealthy can borrow against their life insurance cash value at very low rates, often 2 to 4% annually, without creating a taxable event. They can access their money whenever they want while the cash value continues growing tax-free. When they die, the death benefit pays off any loans and provides tax-free benefits to their beneficiaries. It's like having a tax-free savings account that you can borrow against whenever you need liquidity. But the really sophisticated strategy is using life insurance to fund charitable giving through what are called charitable remainder trusts. Here's how this works. A wealthy individual contributes appreciated assets to a charitable trust, receives a tax deduction, and the trust pays them income for life. When they die, the remaining assets go to charity, but they've used life insurance to replace the inherited value for their children. They get current tax deductions, lifetime income, charitable benefits, and their children still receive an inheritance through the life insurance proceeds. Here's something that'll probably make you rethink everything you know about commodities investing. The ultra-wealthy after 55 often invest in what are called managed futures funds, which use sophisticated computer algorithms to trade commodities, currencies, and financial futures. These funds can make money in rising, falling, or sideways markets because they're not limited to buying and holding like traditional investments. Managed futures funds often have very low correlation to stock and bond returns, making them excellent portfolio diversifiers. During the 2008 financial crisis, when stocks and bonds were getting crushed, many managed futures funds generated positive returns by correctly predicting and profiting from market volatility. The wealthy love these investments because they can zig when everything else zags, providing portfolio stability during turbulent times. The catch is that managed futures funds are complex, often have high fees, and require sophisticated understanding of derivatives markets. You need significant assets and risk tolerance to make these investments work effectively, which is why they're primarily used by institutions and ultra-high net worth individuals. Let's talk about something that might blow your mind about how the wealthy approach municipal bond investing. They're not just buying general obligation bonds from their home state, they're investing in specialized municipal sectors that most people never consider. hospital revenue bonds, tobacco settlement bonds, and airport revenue bonds all offer unique risk and return profiles that can enhance portfolio yields while maintaining tax advantages. Hospital revenue bonds are particularly interesting because they're supported by healthcare demand, which is relatively recession-proof. Tobacco settlement bonds are backed by payments from tobacco companies as part of legal settlements, providing predictable cash flows for decades. Airport revenue bonds benefit from the growth in air travel and often have monopolistic characteristics since airports face little competition. The wealthy often build laddered portfolios of these specialized municipal bonds, creating steady tax-free income streams while diversifying across different revenue sources and geographic regions. It's like building a custom bond portfolio designed specifically for their tax situation and risk tolerance. Now, here's something that might surprise you about how the ultra-wealthy think about international diversification after age 55. They're not just buying international stock funds or emerging market ETFs, they're investing in what are called American Depositary Receipts, or ADRs, of specific companies that benefit from global trends they want to capture. For example, they might invest in Nestlé ADRs to capture global food demand, or Diageo ADRs to benefit from growing alcohol consumption in emerging markets, or ASML ADRs to participate in the semiconductor equipment industry. By carefully selecting individual ADRs rather than broad international funds, they can target specific companies and trends while maintaining the liquidity and convenience of US-traded securities. The sophisticated part is that many ADRs pay dividends in foreign currencies, providing natural hedging against dollar weakness while generating income from companies with global revenue streams. It's like getting international diversification, currency hedging, and dividend income all in one investment. But perhaps the most important thing to understand about how the ultra-wealthy invest after 55 is that they think in terms of total return, not just income or growth. They're constantly evaluating the tax efficiency, liquidity, and risk characteristics of every investment decision. They use tax loss harvesting, asset location optimization, and sophisticated rebalancing strategies to maximize after-tax returns while minimizing portfolio volatility. The wealthy also understand something that most people miss entirely. After age 55, your human capital, your ability to earn money from working, starts declining rapidly. This means your investment portfolio becomes increasingly important as a source of future income. Every investment decision needs to be evaluated not just on potential returns, but on how it fits into an overall income replacement strategy that will support their lifestyle for potentially 30 or 40 years of retirement. This is why they focus so heavily on investments that generate current income, provide inflation protection, and offer tax advantages. They're not trying to hit home runs anymore. They're trying to create sustainable, growing income streams that will maintain their purchasing power regardless of what happens in the broader economy or financial markets. So there you have it. The ultra-wealthy after 55 aren't just throwing money into index funds and hoping for the best. They're using sophisticated strategies and investments that most people never even hear about. From NNN properties and covered calls to structured notes and family-limited partnerships, they've created a playbook for generating income, minimizing taxes, and preserving wealth that goes far beyond traditional retirement planning advice. The key insight is that they've shifted from accumulating wealth to optimizing wealth, and that requires a completely different set of tools and strategies than what most financial advisors recommend to their typical clients.